Hey everyone, we are back with another episode of It Depends. Every single month, I invite our SARE advisors, either Tony Hoong of the CPA Dude or our home buddy Davis Yu from SoCal for all the free legal advice. We create this edutainment series where we can come up with our most commonly asked questions so that we can have some free advice because we're Asian. We're kind of too cheap, So just to help you guys get started to think about how you can prepare for your taxes and for your asset protection. So this week we have Tony Hoong, who's going to give us a mid-year tax tune-up because, dude, it's already end of June. End of the year, we're going to have to we have to, spend the whole winter preparing our taxes and stress ourselves over this. So Tony, take it over and save us from the stress.
All right. Sounds good. Let me pop those slides back up and then let's run through it. All right, so we got the It Depends series back here with the mid-year tune-up. So more or less doing the accountability part of being an accountant. So everything here discussed is for educational purposes / jokes. So if anyone has real questions or serious questions too, drop in the chat, or if you can contact us too, feel free to. So yeah, hopping right in. So surprisingly, this was on my slide deck last time, and not surprisingly again, it's true. So if you fail to plan, you are planning to fail, Ben Franklin. So just making sure that you're planning, especially if we're halfway in through the year for your taxes, understanding what do you owe, or are you possibly getting a refund, or what's your strategy, versus just kind of sitting on your hands praying that the tax return will look good next April. You can control your fate, surprisingly. And you don't have to wait. Actually, you're getting screwed if you wait past December 31st. There's really not anything you can do once the year passes. So right now is actually a good time. It's not too late at all. There's actually a lot of good time to do some tax planning. So get some plan ready versus just having nothing. I always compare a tax plan to like a blueprint of a house, and your house is kind of like in shambles, or you don't know really what you're building if you don't have a blueprint. So get some tax plan. Doesn't have to be amazing, just have some strategy. All right. So the tune-up list that we will go over is prior year taxes. We'll go over bookkeeping, go over estimated taxes, itemized deductions, and tax planning. So that's the agenda for today. And then along the way too, if anyone has any questions, feel free to drop it in. I know taxes is the least sexiest topic in the world, so bear with us here. All right, so prior year taxes. So for those in California, they did give us disaster relief. So your taxes aren't technically due till October, along with the payment, which is the rare thing. Most times the payment is never extended. So this one rare time, anyone in California that was affected by all the rain we had in January, February, you'll be able to file and pay then. And then classic for anyone who does have an extension, your business returns, your 1065s, partnership returns, or your S Corp returns. The extended due date is September 15th, and then the extended due date for your personal returns are October 15th, 10/15. So more likely than not, especially since everyone's an investor, you may be waiting on a partnership who is when you're waiting on a K1. So, that's always a very classic case. One thing to note for anyone that does have K1s or are getting into partnerships, especially into fractional deals, is that like, hey, you could have, a K1 that waits. It just depends on whoever's handling the business tax returns, but you still need to file an extension. And also if you do owe, go ahead and toss some money in to lessen your tax bill, especially with any interest and penalties. So when you do extend your taxes, it only means you have more time to extend the information. It generally does not mean you have more time to pay your taxes. So clean up your 22 returns before it's over if you can. Do understand that a lot of people are waiting on K1, so totally fine. Next part is catch up on your bookkeeping. Believe Annie is actually doing her bookkeeping in the background. And I know Danny actually has a bookkeeper, so do your monthly bookkeeping. If you haven't done any bookkeeping yet, really catch up for half the year. So if you don't know how to do it, find someone to help you with it. It's just better to understand and do it now before it's too late. And also on your investments, since you're, dropping down thousands of bucks here to get this investment property, you probably want to know like truly how it's performing and not just like, cool, like, all right, rent came in, expenses went out, mortgage went out, still some money left. You kind of actually want to understand like how well is your investment doing. So catch up on your bookkeeping right now. Ironically, it actually matters for like it matters all the time, but it matters even more now. I noticed that ever since Biden passed his budget bill last Q4, there's actually more notices coming out. So like the IRS is actually staffed decently, and they're sending out notices now. So just in case you get a magical like notice in the mail saying like, hey, can you substantiate these expenses or disallowing something? Just having your bookkeeping, your books and records ready to go is a good thing. So never a better time than now. And then cost segregation, just one for prior year taxes. I just want to drop this in here. It was 100% bonus depreciation last year, and it's phasing down to 80% this year. So, kind of get your cost segs, probably started towards, Q4-ish. Depends on who you're using for your cost seg company and how long it takes to for them to perform the study. So just something to keep in mind here. So I don't want anyone to have a shock or surprise that last year was 100%, and then like come next year when you're doing your taxes, like, oh, what? Like, oh, so much more. Don't I get more, bonus depreciation? Like, not quite the case. So just a friendly reminder, it's reduced down to 80%. And to use like a example, say if you had $100,000 last year of 5-year property that was bonus and depreciated. So in 23, you would only get 80,000 of that. And then the remaining 20,000 is going to be deducted over the next 4 years. So that's actually changing quite a bit, especially for folks that are doing the short-term rental loophole and trying to get more money back on their W-2. So just be very mindful of cost sags, bonus depreciation in 2023 because of that 20% reduction. One item I've noticed just from a trend wise for folks is that the properties that we're seeing that are returning a lot higher on the cost seg side are more of the fixer uppers versus more turnkey properties, due to the fact that a lot of the parts, the rehab is able to be taken in year one. So if you are investing into short-term rentals, the trend has been to see a better tax benefit for fixer upper / like properties that require more work, but at the same time probably want to bounce. I would never say like let the tax tail wag the dog, like do it for whatever the underwriting says. And I'm just saying, like, if you're really trying to squeeze out depreciation, just if you want more, buy a crappy property, I guess. Not financial advice, just trends I noticed. So prior year taxes, clean it up, get it done sooner rather than later. It is literally half year in now. All right, cool. So this is on to the next slide. Let's top into the chat quick here before I move on to the next one. Yes. Oh, Danny does have a good bookkeeper, actually. I got his docs and I was like, yo, this is clean. So whoever he found is good. I'm not sure if Danny's willing to share, but before all his capacity's gone. Annie, hire VA to hire with the bookkeeping. $5. $5 an hour. That's solid. So I think secretly Annie will probably build a bookkeeping business for us. Sarah will start offering bookkeeping and then at a good rate. Question, how do we know if it's worth doing cost seg? Like how much of the value of property can we actually deduct and how does it work? So how do you know if it's worth it? So on the cost seg side, it's always it depends question, but generally speaking, if you're doing a short-term rental loophole, you can pretty much say, it's like if you're going to get more than $2,000 in a tax benefit, or 2 to 3 to 4,000, depending on how much your costs, that's, you know, how much you need to offset. So say if your study costs you $2,500 and you're going to only see like a $2,000 tax benefit, then it probably is not a good idea. But I bust out the good old handy phone here. So say we bought a $400,000 property, strip away land for 20%, strip away another 20% for phase down bonus depreciation. So on a 400K property, I got 256K left as a cost basis. So I'm going to multiply that by something in the middle, say like 15%. So that's $38,400 of extra depreciation. And then I'm just going to make a blanket assumption of like a 25% rate taxpayer. So times 0.25. So $9,600 tax benefit. So yeah, on a 400K property, it makes sense. So kind of extrapolate your math that way. So good question there. It's not always a good idea. So that's only if you're a short-term rental. Cost segs, I would, this is me, I don't know, just take for a grain of salt, but if you can't take the losses that year, AKA you don't do the short-term rental loophole, you don't make less than 150K AGI, and you're not a real estate professional status, like generally speaking, there's not really a point in locking in your losses for no reason, because it's going to be suspended in a passive piggy bank of losses. So totally up to you. But if you're balling and don't care, it's fine. We should also be friends. So all right, that part, cost seg. And then yeah, the cost seg, key part on the cost segregation and why it's crucial for short-term rentals is that real estate, residential real estate by default is classified as 27.5-year property. However, and then commercials 39-year. However, bonus depreciation only works if it's 20-year or less useful life property. So that means you have to have a cost seg to, you know, strip out the windows, the doors, the cabinets, the sinks into 5, 7, 15-year buckets. So once it's in those buckets, then like your CPA can just take the amounts and then be like, all right, cool, I know what's 5, 7, 15-year. And then you're able to take bonus depreciation on that. So key part, especially since, you know, it's a lot more write-off than normal versus just a normal straight line. And then the cost seg in the year that you buy it, or if you bought it a few years ago, can you still do it? So I generally recommend if you're going to do a cost segregation, you can do it in the year that you bought the property, but you can always go back and then, you know, make sure that the benefit is there to accelerate some losses for you. So good questions there. And then let's see here, Tracy, what's a good chunk of questions? All right, let's see. You have a primary home that you moved out of and recently converted to a 30-day minimum midterm rental. Okay, so you have a primary, moved out, turned into midterm rental. Can you do a cost seg on this property now that's no longer my primary, and would it be on a 27.5 or 39-year depreciation schedule? So if you're going to be, it was your own primary and it's a single family home, you can do a cost seg, just make sure there's a tax benefit versus locking in losses. But it's not bad to actually just do it this year just because you lock in 80% versus if you do it any other year, like 60% next year, 40% the following year, it really takes out the benefit. So probably not worth paying like $2,500 to do it in future years, but yeah, it'd be good just locking losses. And then 27.5 or 39-year depreciation schedule. So your primary home, I'm assuming it was probably a single family home, unless you, I don't know, you live in a 5-plex or a 6-plex, I don't know. But I'm just gonna assume that you live in a single family home. So it'd be 27.5 year. Only when it's used for commercial purposes, it turns into 39-year property.
Wait,
And
Tony,
then,
can you summarize the question a little better? You went a little fast. I don't a little confused with what question you're answering.
oh, okay, let me try.
Read the whole question out in full and then give the response.
Oh, got it. Yeah, versus me mumbling. Solid. Okay, I have a primary home that I moved out of and recently converted it to a 30-day minimum midterm rental. Can I do a cost segregation on this property now that is no longer my primary? And would it be a 27.5 year or 39-year depreciation schedule? And the answer, generally speaking, is it depends, but I would lean towards yes, do a cost seg because it's 80% this year and it's going to be on 27.5 year basis. Okay. And then your house hacking. I am house hacking my new primary. I live on the top floor and renting out the bottom. What is the best way to structure this on my tax return? Do I report rental income? Can I do a cost seg for just the bottom unit that is rented out? Yeah, so if you're house hacking, which actually a lot of people in the community are, is that if you rent out the bottom on your tax return, you'll still report it on your Schedule E. And then on that part, you would just prorate it towards the amount, probably square foot, rooms, whatever reasonable basis that you want to use, slash how aggressive you want to be. So that's kind of up to you on how aggressive you want to be. And you can do, yeah, you can do a full cost seg on the property. It'd probably be good. Yeah, just do the whole study and then you can prorate it towards the like square foot. So say if your top of your house is like 1,500 square foot, your bottom house is 1,500 square foot. You just have, you know, of your 3,000 square foot home, you would take 50% and all on your Schedule E. And then next question is, I need a purchase a new vehicle for business purposes. Do I need an LLC to write it off? So you don't need an LLC to write it off, but it just helps. So you can write it off regardless if you just do the mileage method. So say if you buy it in your personal name, then you just keep mileage and you would prorate it per the business mileage. So say just in your personal name, Tracy, and then you do use it, you drove 10,000 miles 1 year and 9,000 of those were business miles. You just take 90% of the car value to depreciate, or you can use the mileage method. So for writing off cars, just as a heads up, is you can either do the mileage method. So you just take it, multiply by, I think it's like 57.5 cents, 58 cents, give or take a couple pennies. It just keeps changing every year. Like 1 year they decreased it, next year they increased it in the middle of the year. Or you just track actual expenses and depreciate it. So one or the other. And then if it's in the LLC name, yeah, just write it all off completely if it's over 6,000 pounds. If it's less than 6,000 pounds and it's full business use, then you're able to take 22.5K the first year, and the remaining would be depreciated over 4 years. And then your husband's LLC is in California, but we moved to Hawaii. Can we buy a car under his California LLC in Hawaii? If you do not have to have that LLC in California anymore, I would dissolve it because you're going to be paying $800 for the rest of it. But if you have to keep it, yeah, you can keep, you can use this California LLC to buy the car. Cool. Good questions. All right, Justin, if you STR for the first year, cost seg and qualify as rep, and the next year you do midterm, not an STR, or if you're not rep anymore, how is depreciation affected? So if you do it your first year, you'll take all the losses against, you know, your active income. And then the second year, the depreciation will not offset your active income. The activity will default back as passive, so that you won't be able to take depreciation against your active income. And then Annie, say you have a primary home with 2 rooms and you rent out 1. Do you prorate 50-50, or is it only the sizing of the room you're renting out? So this one's like, there's many methods that I've seen on this. There is, you could literally square foot it, your size if you want. You can do like rooms, so 1/2, 50-50 in this case. So like, generally speaking, it's like any reasonable method that you can use to appropriate the cost. So you, in this scenario, yeah, 50-50 is available. If not, you can just split it out per the square footage. So say main living is 200 square foot. Well, it's kind of small, 400 square foot. And then each room is 100 square foot. So you're at 600. So you could take 100 over 600, or you could just do 50-50 of the rooms. Depends on how aggressive you really want to be. Fun fact, actually. So I don't know, it's not fun actually. So I have one dude, my tax manager, Bill, he used to be an IRS auditor. And I was just chatting with him, and Schedule E's actually don't get audited really at all, because there's not much money to be attacked there. And generally speaking, because it's always passively, like all the losses are suspended and they're passive. It's more so Schedule C's that got audited. So just a fun fact to tell you guys, like Schedule E's don't get audited that often. Right. For Connie Lou on Facebook, for house hackers, what is the best way to write off expenses? I have renovation cost and capital expenditures and plan to rent out 2/3 of the house. Is it true that you cannot write off renovation expenses if the house is reflected as a primary house on tax, and you can write off a portion of the renovation expenses if you reflect the house as an investment property? So if you house hack, the renovation and capital expenditures, you either depreciate them, or if they're like 2,500 or less in nature, you're able to do like the de minimis election, and you can expense those items right away. But you do, all of it does add up. So say if you spent $100,000 on reno and capital expenditure, 33 grand of that would just be added to your cost basis of your house. So when you do sell it, your house, your cost basis is 33 grand more. And then the other 67 grand, either you would just depreciate that in the current moment, run the cost seg, do a bonus depreciation on it, or do a de minimis election and expense those items. So you do get whatever the business portion of the house is. You just have to prorate accordingly on Schedule E. And then Callie, sorry, newbie question. No newbies at all. I'm a noob, so Annie just magically decided to invite me here. But is cost segregation a service you request from a CPA, or is it something you do your own? So we have like a referral partner for cost segs that we use. Essentially, it is a firm that has engineers paired with CPAs that specialize in the studies. So yeah, there's many companies that are out there. And then yeah, just validate the quotes. There's an online one, and one of my clients ran it this year. I'm kind of excited to see if it works the next couple of years, if we get audited or not. It was like 600 or 500 bucks or something. It was like dirt cheap. And it came out okay in terms of like the amount. So generally what I do is like, I see how much percentage you're able, or that cost seg report allows you to write off. And it was like still double digits, which is like fine. So it's interesting to see. All right. And then AL, thanks for doing this. What's the best way for a W-2 earner to offset income? I dabble in real estate in that I manage my own properties that I don't live in, and other properties owned by other people. Does it make sense to do this as a business, as a sole proprietorship, and will then allow for expense write-offs for car, office space, mileage, etc.? I would not be able to qualify as a real estate professional as I have a day job. So many ways to reduce W-2 income. The one that I think the SARE community uses a ton is the short-term rental loophole. That's always big. Alternatively, businesses that are in loss positions the first couple of years. That's another way to offset your W-2 income. And lately, we've been pushing a ton towards investment tax credits. So those would be energy/solar credits that you can do to offset your W-2 income. And then if you want to kind of start up a property man, let's see, and other, if you want to start up a property management company, yeah, it's a great idea. I don't know what the legal ramifications are. Maybe Davis knows, but I think in California, do you have to I'm assuming you have to be licensed pretty hard if you're in California. California just licenses.
Yes, so California law does not allow real estate agents to be property managers.
unless their brokerage, they have a brokerage license. So their brokerage has to have a division where it's for property management, and they allow you to do it as their agent. And plus they have to have a bank account that's in escrow, so that that person that as the agent, you cannot collect the rent yourself, open up your own business and do property management. It has to be done through your brokerage.
Oh, okay. So like some Joe Schmo like me can't be like, yo, let me collect your money and take 10%.
No, no, that would be against California Department of Real Estate law. So sorry. Hi,
Hi,
Ian.
sorry. I'm the one that posed the question. So I guess quick follow-up with that. If I'm not able to do obviously the PM route, is
Yep.
there, if I'm like a sole proprietor as like a real estate consultancy, is
Oh, yeah.
that
Oh,
does
yeah.
that qualify?
Yeah. That's what the small business part would be. So if you started up a small business and then say you did some consulting or some side jobs, anything that shows some type of income. So then you can write off, a home office, some car, your phone, a lot of your like expenses that you use in your daily life. That way you can offset that against there. And then if you really get into the business and say you're like really investing into it, those loss, if you generate a loss, then you're able to reduce your W-2 income.
Okay. I read that like in the first 2-3 years, like if I, have no income really to offset the loss, like I guess my hope is to obviously to offset those losses as a sole proprietor against my W-2 income. Does that raise red flags if there's no income coming in on the sole proprietorship? Because I've read that like, well, if you barely have like a contract, you can show startup costs, right, for the first like 2-3 years, but beyond that, it gets very fishy.
Yeah. Generally speaking, we like to show like at least like $100 of income.
Gotcha. Yep.
The first year, like $100 of revenue is what I'm talking about, and then like you can have like $10,000 of losses. So then you have like $9,000 of a loss, or no, $9,900 of a loss, and then that reduces your W-2 income.
Gotcha. Thank you.
Yeah, you can do that 2 years, and then by year 3, I'd scrap it. Otherwise, you're gonna get audited.
Understood. Thank you.
Yep. Good question. Small businesses too. Like, I know that we're all, real estate investors, but it's like you kind of need like a shitload of cash to have a down payment to go buy property, unless there's other magical ways. But you just got to stack cash. So having a side business on top of the W-2 is good, just so you have more cash and realize some tax benefits along the way. Because I mean, if your cell phone's like $100 a month, 1,200, your home office is a couple thousand, 3,200. I'm sure between all your software apps and everything, the $100, some 1,200, like 4,200. Like, say if you just round up, I don't know, $5,000 of just normal life expenses into some type of business, times your effective tax rate, say 30%. I mean, you're saving $1,500 a year just by doing that. So small businesses, look into it, get some freelance work off Upwork. Cool. Let's see. Oh, tech. Yo, dude, good job on the video, man. Saw just that blowing up all over social media. So, but anyways, if you're house hacking, long-term rental, 2 rooms, and then short-term rental, 1 room, can I still use the STR loophole? And then 1 reply, or 3 LTR, or LTR 3 rooms and STR 1 room, would STR loophole still apply? So you would want to, you have to prorate it, because you have to meet the prong of average stay is 7 days or less. So the other 3 rooms would fail on that prong. But if the STR 1 room is meets that prong, then you would I guess in this scenario, just say if you did the room method, you'd get 25% of the STR loophole. But on that note, if you're past the mom and pop special election, 150K, then the cost of running a cost seg may not work, because I think on that $400,000 example on a 25% rate, I said that's 9,600. Then if we use that same example, if you only take a quarter of that, I'm just gonna round up to 10K and multiply that. So it's 2,500, but then the segs cost 2,500, then it'd be like a net zero. So not worth the headache in that case. But I don't know how expensive your home is. That my example is a 400K home. Right, Justin, and then are you able to re-explain the vehicle write-offs? I have 2 vehicles, both under my name. One I use for work exclusively, take mileage, or was there another method, total value by X number of years? Yeah, so the on your vehicle, so since it's in your name, there's a whole, like, there's 2 different sets of rules. There's personal name, there's LLC name. So for your purpose here, we're just gonna say it's in your name. And yeah, because you said it's under your name. So the one that you use for work exclusively, that one's kind of easy because you never have any personal usage on it. So you can either take the mileage method or you can do the actual expense method. So say if you drove 10,000 miles a year times the mileage rate, I'm just gonna say 60 cents. It's not right, but it's give or take 2 pennies. Then you would get $6,000 of a write-off, or you got to pick one though, and you can't change it each year. Or you take your total cost to maintain the car, so your gas, your insurance, your tires, your repairs. That would be your actual expenses, and then you get the depreciation of the car. So you bought a $100,000 truck, and then divide by 5 because a useful life of a car is 5 years. You get 20K plus all the actual expenses, and then finally. So that's one or the other. You got to pick one. Generally speaking, mileage comes out higher, but that's generally speaking. Hopefully that clears up your question. If not, just let me know. I was trying to explain S corps to my fiance and I failed. So apparently I'm not the best explainer. And then AL, can you explain what the short-term rental loophole is? Yeah, so the short-term rental loophole, let's see, it's pretty, let's see, I don't know, Danny, you want to take it? JK. So short-term rental loophole, it's a loophole that allows you to write off passive or rental property income losses against your W-2 income. So the reason why is that real estate is defaulted as a passive activity unless you meet one of the ways to unlock it. So when I say unlock it, one of the ways is short-term rental loophole. And how you qualify for the short-term rental loophole is that you have an average of 7 days or less. So your total days divided by total stays. And then you can have, 3 30-day stays and then 31-day stays, as long as like the fraction equals 7 or less, you're fine. So that's prong number 1. Prong number 2 is you have to show material participation. And generally speaking, most folks that we work with that do it and execute it is they work 100 hours or more and no one else works more than them, or they meet 500 hours and anyone else can work more than them. So then finally, you did all those jumping through the hoops. You now turn this defaulted passive activity as an active business. So this whole short-term rental loophole, just for historical context, is actually based off of bed and breakfasts. So it was kind of like carved out for this, and then it's got revived for Airbnb purposes. So that's how this, and then so what you do is that, buy a home, rent it out, maybe get 30K revenue, spend 30K, furnishing the place, and you run a cost seg. The cost seg produces 100K of extra bonus depreciation. You take that 100K, offset that against your W-2, and boom, you got a big tax refund. So that's a short-term rental loophole.
The one thing to call out on that, because I think Tony and I were chatting about that one time, I was pinging you about it. You put that on a Schedule E, but if your I guess your AGI is greater than 150, it like drops it to 0. So you have to it has to be on the Schedule C, so you have to actually have a physical business in order for you to take that full deduction. Otherwise, it goes to 0.
Yeah. So the E's generally if we like to see it on the E, but yeah, the C is another workaround too. It just depends, because the C too, if you want to buy a car that year, it's kind of like a good time to use the car, just because you can take up to 480K of a full loss if you move it to the C, actually.
Thanks for that. So if I can't do the E and I push it to the C, do I have to do anything different, I suppose? So the losses go in the C, is that right? And then that offsets your AGI?
They can go on either. It's just how do you want to present it and what's your income levels? That's why the whole thing is always like it depends, as the joke and slash it kind of holds true. It always depends
Yeah.
on like how much money do you make.
And I'm sorry, what's the C?
Schedule C for sole proprietor.
Oh, gotcha. Okay, thank you.
All right. Let's see. Okay. Is there an income limit on the cost SAG? No, you can make a ton. So we got people making 7 figures and running cost SAG and using bonus against their W-2 if they qualify for real estate professional status or short-term rental loopholes. Lynn, are there any tax benefits of leasing solar panels? No. Well, I guess you could say yes, because you lease it. It's a payment towards expenses to make income, so you get a deduction for it. But if we're talking about investment tax credits or solar tax credits, no, you have to own the actual panels itself. Davis, if you want to say, yep, all right, yep, leveled up. 10 years later, tied it down. So gotta get those tax write-offs, right? Gotta get there. Well, I gotta get married first, but yeah, one step at a time. Car write-off. If you do mileage write-off, are you required to document every mile to prove it was for business purposes, with the most simple way just to write off the total amount the car was purchased? So unfortunately, if there's any personal use of the car, you do still have to track mileage regardless, and you have to prorate it. So in terms of like tracking miles, I just recommend like an app like Mile IQ or QuickBooks. I think they have a native mile tracker too. And then Danny does not want to explain the short-term rental loophole. He's just a pro. He just doesn't want to give away all the secrets. Who's making 7 figures, asking for a friend? Yeah. Trumpy dumpy, she says. All right. Man, you guys are good people. All right. All right, cool. So good questions. So let's see the next part of the slides here. Let's see. Super Dave. Nice. I like the name. Basic question. Do we need to keep physical receipts, or scanning and keeping them electronically is okay for our expenses? So you don't need the physical ones. Yeah, just take a picture, toss it into a Google Drive folder and call it a day. But good like point, because it's very common questions like, do you need the receipts? And it really, if you get audited, it always depends on the auditor. So like we work with auditors that don't care. You just give them a bank statement, they're cool. And then some are just not cool, and we're like, I need the receipt. So really depends on your luck that day. But yeah, it's regardless, scan and photo is great. If you really want to shoebox it for fun, be my guest. Sure, our OG Asian parents would love it. All right, cool. So next slide, bookkeeping. Yeah, I just want to mention the importance of bookkeeping is just please do it. Is all I ask. Like, not only does it help your accountant, it's just like I said earlier, it just helps for you to know how well is your investment doing. Like the funny thing is, like, you spend so much time on underwriting off of hypotheticals. So then, like, are you actually doing actuals? So like just general finance, right? It's like always comparing the forecast against the actual. So yeah, just do your bookkeeping so you know how you're doing. Apps to do it: QuickBooks, Stessa, spreadsheets, Wave apps, pen and paper. Just do it is all I ask. Annie, for bookkeeping with receipts, like hang out with our SARE homies, our friends with benefits. How are you guys tracking what you're doing or who you're meeting? So for me, I just on the receipt, just write down like who you're with, and then who, what, when, where, why. I guess the receipt has the when and the where. And then put the why. So put the who and the why. So who did you meet? Why did you meet? And what did you discuss? So do that. So for fun fact is, I don't know why I say fun fact. I guess it's just fun for me. But the most audited items on a Schedule C is meals and not entertainment anymore because it's disallowed. So all your golfing and whatnot's disallowed. And then your travel, actually. Those are actually two very, very sensitive items. So if you're traveling somewhere too for business purposes, document, the who, what, when, where, why again. More so like, why are you there? What are you conducting? Going to SARECon, writing that off. Actually, I should plug that right now. So anyone that's not going to SARECon needs to. I think Annie still has tickets left. So I don't know.
And I heard that a certain person named Tony Hoong or the CPA dude has discount codes for SareCon. Just
Oh yeah. Hit me up. I will go find what this discount code is in my email. I guess that's the call to action or the hook here as I'm beefing up my marketing. JK. Worst salesman ever. Tenzin, good part due. We put that in calendar as well. Actually, that would be really good for people who are doing the real estate professional status for your audit log. So if you're not using a tool like Reps Tracker, but substantiating like all your meetings for real estate professional status, that's actually a really good way to do it. Because it's like, if you get audited, like the auditor's going to buy a calendar that you just printed out of like years back. So good ups on that, Tenzin. And then Davis, oh man, he's gonna bust my chops here. Okay, you say that the most audited items are meals. How do we know how much we can spend without risking that? Probably depends, but you have a good little real thumb. So so actually the IRS like wording is it can't be lavish and extravagant. So like probably your like $200 tomahawk steak probably won't fly, but they generally say ordinary and necessary. But at the same time, it's hey, was it a business meeting to close a big deal? Everything is facts and circumstances, but you probably just don't want to be doing like, I don't know, $300 omakase like every week. Probably a bad idea. Then Callie, is it too late to do a cost seg on LTR if you already filed taxes for the year? You can amend it. That's totally fine. So as long as you have the benefit weighs the cost, you can totally do it. So just amend it. Never hurts to do it, especially if you just did it in 2022. Cool. Bookkeeping, and then let's see what we had next. Just as a tune-up, estimated taxes. So this estimated taxes weren't really enforced the last 2 years, I noticed. So I didn't really tell that many folks unless they had like a massive surprise bill that you should do it. But yeah, the last couple of years it hasn't been really enforced, I noticed. And then this past year, because of the increased budgets, they actually have money to send out notices again. So if you're not doing them, time to do them. For California folks, you actually have till Q3 to have a little bit more extension. But I always say, I don't like to say it because if you don't, people essentially just have really bad money habits. Is if they have the money now, they won't be there tomorrow. So I just say, hey, just pay it now every quarter, regardless if you're not, unless you're super diligent. So like I said, the IRS is actually enforcing it. Q3 is going to be due September 15th. And then Q4 is due January 15th. Don't ask me why the quarters don't add up to normal quarters. It's just the IRS. Q3 for California is weird as 0% is due. They want 30% in Q1, 40% in Q2, 30% in Q4. So it's 0% in Q3. And everyone in California, just as a heads up. Right. So estimated taxes. Another tune-up item for folks is your itemized deductions. Usually everyone just scurries during tax time to be like, oh yeah, how much did I have for medical? How much did I donate? Property tax and mortgage interest is easy to dig up, but more so like just as best practice, every time you have medical expenses, buying like your, I guess your co-pays, any prescription meds, any stuff like that, cover that, add it into a sheet, just keep it running for the year. Charitable donations, just clean out your closet, all the junk that you're storing at your home is actually worth some money. So say, for example, you do itemized deductions and you find like $1,000 worth of stuff. I don't know, Asians just hoard, right? So if you take that all, go to Goodwill and you grab that receipt and say if it's worth $1,000, your effective tax rate is 25%. It's worth $250. So some free food money. All right, so that's itemized deductions. Just keep it there. Oops, lost something. And then let's see here, Annie, or let's see, oh, Tenzin. Are quarterly taxes required for LTR/STR income? It depends. So it depends on if you're in income position. So say if like you're just like killing it with the STR game and you have crap load revenue, minimal expense, post depreciation, and you still have a positive, and generally speaking, most rental real estate is always negative after depreciation. So say you magically have like $10,000, and so you are supposed to pay estimated taxes because the IRS system is a pay as you go system. So as you earn money, you pay it. But if you have a W-2, you're technically paying in some already. So you could lessen the amount of the estimated tax penalty. So good question there. All right. Annie, I feel like we need a CPA dude accountability group for us to do our taxes together, spend a day together scanning receipts, inputting our info. Yeah, inputting. Yeah, pulling teeth, pulling docs. Do you offer a second opinion? I think I would need a new friend. Second opinions. Yeah. Actually, I think I do say that a lot. I think it's like, someone didn't want to work with us. I'm like, all right, cool. Like, have a wonderful day. Like, you want a second opinion? I think I actually do say that in my emails. So if I sent that to you, probably saw that. Connie, can I donate my furniture to the house? I am doing house hacking. Oh, that's not donate. Yeah. Sorry. The donations actually have to go to a charitable, like a charity. So like 501c3s or Goodwills, or I don't even know what else is there. Yeah, SARE should start up a nonprofit just to get donations.
Right, you're the one who talked us out of that. Don't forget.
Well, the one Nelson wanted was so complicated. I was like, oh yeah. If you wanted just a simple one where you just take money, not memberships, it could be a different story. Okay, I'm not killing it, so I'm good. I don't know, man. I'm sure you're killing it. You're just too humble. That's a sleeper thing. Everyone in SARE is like filthy rich. You never know who's who. So like, I don't know. It's just fun talking to people because yeah, Tens is probably like, I'm not killing. Probably like secretly has like 8 figures stashed underneath his bed, along with many other members in the group. So itemized deductions. And then tax planning. Yeah. So like I said earlier, at the beginning of all this, just do some planning. Just was a joke I had. Oops, go back here. Yeah, this good old classic one. If you fail to plan, you're planning to fail. Ben Franklin. So, I mean, it can be as easy as like, all right, I'm going to buy an STR and it's going to produce me X amount of losses. I'll offset my W-2 income. I'm going to do a Roth IRA. Boom, you did something versus just praying to God that your W-2 had enough withholdings. Like most people kind of just bank on the W-2 had enough withholdings. And fun fact is that ever since tax reform, more or less, most people do not have enough on their withholdings. So here's some tax planning. This is just some numbers I ripped out with one of our clients. The Augusta rule, renting out their homes themselves, accountable plan, doing reimbursements, home admin office, home office, doing still 401k, fringe benefits, reimbursing yourself for a gym membership, cell phone, And then if you're self-employed, health insurance. So writing that off. So do some tax planning. That's primarily what we do. And then, yeah, that's pretty much it. Yeah, if you can find us, it's pretty much everything, the CPA dude. This number is the text number. Not a big fan of calls. So if you call, it actually doesn't answer. It's just the text number. And then, yeah, anywhere else, I probably should put Facebook in here, but all good. And then, let's see here. Tracy had a follow-up to the house hack midterm rental question. Can we still get material participation for a house hack in order to get the benefit of the cost seg? So you can do the material participation, but you won't unlock, like the cost seg, I guess you can do the cost seg too, but you won't unlock the passive loss against your W-2 because you're going to fail that prong of average stay of 7 days or less. Unless your midterm rental is not that midterm. I don't know. So all your like total days divided by total stays equals 7. It just has to hit that 7 number. So, I mean, you could midterm it out for like, you know, a couple 30s and then a crap load of 1s and 7s towards the year end just to hit that 7 amount. Right. Justin, are you able to take deductions for things like credit card annual fees, luggage for travel to SARE? What are some of the best tax deductions to take? So if your credit card annual fees are related to your rentals, and you're primarily using it just for your rental properties, you can spin it up that way. Your luggage for travel to SARE, roll the dice. I mean, like I said earlier, Schedule E's aren't audited that much. Or if you mean like just your travel to charge $25 to ship your bag, that's 100% for sure. Won't get in trouble. Best tax deductions to take. I'm a big fan of like anything that is part of your personal life that you already pay for and just finding a way to deduct it. So if you kind of think about it, like everything that can be a tax write-off, you want to write off against your, man, that was terrible. So anything that you can write off against your taxes you want to, like say if you bought like AirPods, right? I don't even know, is this $200? And say your effective tax rate is 25%, right? You just got $50 off your AirPods. So I say the best tax deductions are the ones you are already spending money on. Like don't go find tax deductions just to get tax deductions unless it's gonna make you money. So what we do generally is that we'll just take like 3 months of like statements, just review them if they don't feel comfortable with taking deductions. So some people are super savvy. Some people are like, I got no idea. So yeah, we can always review that. And then Super Dave, oh, you got a 501c3. Donate, let us know the name, dude. Can I make donations to reduce my taxes, or is that conflict? This is the magical question. It's been my bucket list. I've never figured out the answer, nor have I really looked. But like, you see, like the Bill and Melinda Gates Foundation, right? It's a charity. He donates towards it. Obviously, he takes a deduction. I just don't know what's arm's length / I just haven't had time to go look. But if anyone knows the answer to this question, I would be very interested, so I don't have to go do the research myself. But Bill Gates is doing it somehow. So why can't we? I guess someone just needs to figure that out for the group. So if you find out, take one for the team and let us know the answer. All right. And then Davis, aside from the texting group, are you still offering 30 phone consultations for the full members of SARE? If I magically have time, which this July is bad because actually Davis is taken up all the time. So July is closed because Davis stole all the time. But we'll squeeze some things in if it's there. Or if you're an existing client, of course, you find time, you get time. And then also remember you have a cool spreadsheet for tracking taxes that people can get from you for free. And it keeps on telling Tony for SARE freebies. Oh yeah, so yeah, I should probably step up the whole email, give me your email, send the list thing. But for now, if you just email me, happy to give you the template. So that template has your rental expense tracker, your Schedule C, sole proprietor tracker, home office, accountable plan. I think I put in a budget in there too, because not only do taxes matter, but like if your financial health is not great, it's going to make the default. It's an Asian group. Asians are pretty good with money. Otherwise, parents probably say something. But there's a budgeting spreadsheet there, just because there's like no point in saving so much tax if your financial health is crap. Okay, my nonprofit is called Cali Bartenders. There we go. Cali, educational and fun. All right. And then Connie, I have an orthodontist in New York City that I fly to every 3 months. Can I write off the flights as medical expenses? So the flights probably would be disallowed. There's like a pretty deep section in the IRS code for like what's qualified medical expenses. So if you lived in, I guess like a town where I grew up in, where it's like 10,000 people and there's not a ghost of a orthodontist and you can't find one close, you can maybe justify it. But if you have to fly, you probably won't fly. Man, bad puns, bad jokes, Jesus. Because the IRS probably just argue like, you could have just gone to the next city 2 hours out. Cool. All right, that's good there. I think, yeah, if there's no other questions, I'm out of bad jokes, bad tax tips. But if you need anything, websites here, cpdu.com, email is probably the best way to get to me. IG and TikTok, I don't check those often. I try to like every 3 days. And then, yeah, texting, I do get to like every day at night. But if you really want something, email me. Cool. Yeah, you guys are welcome. And what type of medical expenses are you to write off and how much? So the medical expenses, they all qualify as long as they're qualified medical expenses. So like anything that's like needed, then you can take like if you visiting the doctor, prescription drugs, those are easy. Probably like me getting a hair transplant because my hair's falling out probably won't fly. I could probably argue there was a fun article that was out there. There was a lady who got breast augmentation and then they wrote it off because they were an OnlyFans model. So I guess how aggressive you want to really get with this. So see how you want to do it. But yeah, you guys are welcome. And then last time we swear. It's all good, Tracy. It's all fun and games. So back to midterm house hack question. If I can't materially participate, what is the point of the cost seg on the house hack? So the only point I personally see, or 2 points, is that one, if the midterm rental is very profitable, and after normal straight line depreciation, it's still an income position, then you'll pay income tax on it. But if you cost seg it and you accelerate your 5-year, 7-year, 15-year property, then that hypothetically it will allow you for more depreciation just to offset that normal income. So that's number one. And then number two is that just to lock it in for 80% losses right now, versus next year, it's only worth 60%. So those are the two things. But yeah, you're kind of paying like $2,000 to $3,000, unless you're going to use like the online one. That's like $600 to do your cost seg. And then Lynn, can you deduct all medical expenses not covered by insurance? Yep. Yep. As long as they're qualified medical expenses. There was, a client sent me this. It was like one of those like pools, like to build strength or something like that. That was for his like aging mother, actually. And then it was funny, like salespeople are actually good at taxes. So in the article, it says that you could write it off for qualified medical expenses if you need like some physical therapy to repair your body. And I was like, wow, because I always get that one. And then like the people that sell like ATVs and like four-wheelers and stuff, they're like, oh, you can take this as section 179. I'm like, man, salespeople are learning a tax code too. Solar people are good at it too. They know their tax credits. Right, cool. I think that's it. If not, forever hold your peace. Or
Yep, I have a couple announcements for folks. So we're almost back to SARE times. I'm really excited that we're going to be meeting this year in Costa Mesa, which is next to Irvine, an Orange County area. And this year, oh my God, I am so excited for the guest that we have speaking, our keynote speaker. So I don't know how many of you guys are Bigger Pockets fans, and I know Johnson, you should have read this book. So back when we first started SARE 3 years ago, we spent like about a month doing like a book club on the Bigger Pockets tax savvy books. And there are about 30 of us who just met week on week, and we would go over the books and talk about these tax strategies. Well, you know what? We have the authors, Amanda Hahn and Matt McFarland. They're going to be coming to speak at SARECon this year. So you're going to have an opportunity to get to meet them, go grab your books. We can do autograph signings. And then also really on one of our days, we're having not only them speaking about the taxes, we're going to also do like a legal and tax sections so that you guys are more familiar with all of these things, because there's just so much intricacies on this. In addition to that, I noticed there's a lot of people who are in the Linfinity group. Anne's in there, Tracy's in there, Danny's in there, so am I, and a lot of other friends. And for those who are not familiar with this, there's a large group of us over in the Bay Area that are getting mentored by Tony Lynn, the other Tony, to teach us about multifamily syndications. And he's gotten us connections with Paul Peebles of Old Capital Lending, which is like the biggest thing outside over in Texas and Dallas, doing all of the loans. And they know so much information about the overall market and economy. So he'll be there to speak to us. We also have a secret little field trip going to Dallas where we're going to go meet him, go to this conference. So that's all coming up. But as for SARECon, the dates are July 29th and 30th. If you guys are coming and you guys want a discount code because we Asian, you know, so go hit up Tony for that special code. And reminder is for everyone to book your hotels by July 7th. Okay, because July 7th is the last day for our group discount. And then if there's any of you guys are located in SoCal, we're also going to be doing a barbecue and bonfire day Saturday, July 8th at Lake Paris. So go and check that out. We're going to combine 4 chapters in SARE from SoCal all the way to San Diego to come out for this event. So it's going to be super fun just to get everyone all hyped up and ready for SARECon. And then last reminder is that we do this It Depends series once a month. We alternate between taxes with Tony and then also legal with Davis. And after this episode is done, we will record it and put it on YouTube so you guys can refer this back to it later. So next month's episode is going to be on operating agreements, you know, basically your prenup with your work spouses. So be sure to check that out on July 20th. Other than that, thank you guys for sticking with us for this whole hour, and we're going to see you guys soon. Take care, everyone. Bye-bye.
See you guys.